Stand by.
But we're going to wrap
money in the bank.
Rates are good.
Hey, welcome back to the program. This is your Real Estate Chalk Talk. 612-627-8000. The Hittner Group, hittnergroup.com. Kelvin Kaemingk, ladies and gentlemen, 651-231-2500. Give him a call. Kelvin, I got a question for you.
Oh, I don't think it's question time yet.
I'm going to ask you one, though, because I want to know, before you go blathering on about rates and
blah, blah.
mortgages, I want to know about problem solving. Because what I had an issue this week with problem solving. I'm not going to get into it now because I want to ask you, with this rate environment that we're talking about, with $30 trillion in equity, what can we do other than say, well, rates are at 7.5% and, you don't make enough money?
Mm-hmm. What can we do?
Mm-hmm.
Well, in terms of just getting people
solving
positioned,
the problem and get them positioned so that they can afford the house. I mean,
well, I think one of the things that we do, and it was interesting. We've talked about the last while now on the radio show, and we've always talked about it in terms of that value proposition between us versus someone else. But it's really the conversation you have and the problem solving that goes into the value proposition that you give people, and that is like, for example, and they were talking about some of the talking heads as well. Someone sells a property and we're using that equity. Typically people don't even think, and they go, oh, I made $100,000 on my house. I'm putting $100,000 in the new house.
right.
And that's just, in most cases, if there's existing debt that we can get paid off, it makes so much more sense to pay that debt off and put less down on the new property.
And why is that?
Well, one, you're going to have a lower interest rate. It's deductible on your taxes, right? So we've got that. So we take our overall family cash flow. We do a family cash flow analysis where we look at, okay, what's our current outlay? And then if we did something different than just throw it all into the new home, what's our cash flow analysis look like when we've done what we said we're going to do in terms of maybe less down on the home, but we got rid of this debt. One I just got done, we close next week. They're currently in a Chapter 13, 4 payments left, right? You have to have 12 months that you've made payments on time, right? But they're in a Chapter 13 right now, and we redid their whole thing, and they $109,000 from the sale of their home. What do we do with those dollars? Well, you know what we did? We paid off, because they're in a 13. They bought 2 new vehicles since then. Guess what the interest rate is on their vehicles? 21%.
Oh, wow.
Oh, wow, right? Crazy. Credit cards that they're able to reestablish, 24%. Guess, and they have accumulated accumulated some debt again.
Some balances there.
Yep. So we're paying off $77,000 of
high interest
debt. And they are just like, oh my gosh. And we save about $178 difference in terms of overall cash flow. But think of the interest that they're no longer going to pay.
Oh, yeah.
It's incredible.
That's dirty interest too, because it's not deductible.
We call it good debt, bad debt, right? So now we have deductible interest, and their rate is, we lock them at 6.5, 6.25, 6.5. Like all day long you do that, because your effective rate on that, and people don't care.
So what was their monthly, you maybe don't remember this, but what was their monthly cash flow savings?
After everything's done, that's $178 that we're saving now, because they're literally almost doubling their house payment, right? So you look at that and go, oh my gosh, my house payment's doubling. No, your overall cash flow, you saved almost $200 a month, brand new home, new construction, and no other debt.
Right.
And they're just like, that we don't even know what that's going to feel like to not have these other debt payments.
And the beautiful part of that is, in whatever this mythical time frame is, that when rates go back down, they have the opportunity to refinance and maybe save themselves another $100 a month.
Yeah, for sure. So in terms of problem solving, that's a big one right now. So if people are listening, you go, gosh, we do have some of this existing debt here, and we noticed on our HELOC we're paying 9% now. We noticed on our credit cards we're over 20%. It's rare to have a credit card under 20% now after the Fed's done what they've done. It might be a good idea to look and say, okay, well, what if I did refinance, took some cash, paid that off? What's my cash flow? What's our analysis look like after the fact? And it's interesting, we're part of Loan Depot, and Loan Depot has kind of two silos. One is a consumer direct silo, and all they're doing is cash out refis, and they're doing really well. But they're just talking to people that have debt, that they're saying, hey, let's consolidate this debt here because of the equity we talked about in our earlier segments, and let's move that debt into deductible interest now and a lower rate. And even though the rate might go from 4.5, let's say, to 6.5, you know what? They got rid of all this debt that was at 20%. So it makes some sense, and it's interesting just to have the conversation and to do that.
And you need to really, because you're not talking about taking a second mortgage.
No.
You're talking about refinancing the existing mortgage, rolling in this other debt in because of the values that we have, and then having now one payment that is primary home payment, fully deductible on your
interest.
Your interest.
So a lot of different ways, and but that's one way that we're solving problems right now. I want to touch on, because we just got a lot to cover in the segment. The Fed met this past week. I'm just going to read some of the bullets I had down from the Fed meeting breakdown. The Fed leaves interest rates unchanged but very hawkish, meaning they anticipate Fed members think there will be 2 more quarter point hikes coming. So they skipped this one just so they can continue to analyze, because a lot of things aren't making sense in terms of the fact that inflation's going down, but yet interest rates are going up, and why is that? And there's some logic because of the banking. We don't hear anything about the banking crisis because the media is going to try to keep that stuff tampered down. But there was a pretty big banking crisis, and what happens in that then is everybody's taking a run. The way the banks work is they have to keep 10%. So you put 200,000 in, they got to keep 20,000. Well, when you want to go, and then they take that other 180 and they're going to lend it out, but they have to keep some of it. They might put it in treasuries, mortgage-backed securities.
Right.
But when everybody comes to go get their money, now they're selling, and that's driving those rates up. And I kept saying May 10, May 10, May 10, because that's what all the talking heads were saying, May 10, May 10, May 10. And we had Barry on yesterday on our national sales call, and he goes, we were wrong. I mean, but everything lined up that we said would happen, but because of this banking crisis that you don't hear anything about, and they're also saying the economic data that you're seeing, there's an asterisk by all this stuff, and you're not seeing
the real bit.
You're not seeing everything, and you got to be a little cautious on what you're seeing. So forecasts on core inflation 3.9% by the end of the year, up from 3.6. Unemployment rate expected at 4.1 at the end of the year versus 4.5 previously. GDP expected at 1% versus 0.4 previously. So bottom line is they still anticipate that we're going to see rates come down. They think we'll get to that 5 to 5.5, and gosh, I would just love living in that space, man. So it'd be fun.
So then they're always, the thing of it is that they're talking about that now. They're talking about, well, maybe Q1, Q2 of.
They say by the end of the year we should be back down. But we'll see. They've been wrong so far. So
I'm thinking that next year is going to kind of look like this year.
Do you? I sure. Well, there's thoughts on the thought on that is, we will just continue to build this pipeline of refinances.
Oh, it's going to be when rates come down because of all this equity. And remember, there's a lot of built-up demand bubbling up now because of the shortage of inventory. And that is, again, it's so structural. It's just when rates come down, we're going to see activity like we haven't seen ever.
No, I know. It'll be good. So where are rates right now? You have to be thinking kind of high sixes, sadly. 6.5.
High sixes is actually
6.5 to 7
something.
Yeah. So 6.5 to 7. You're paying a point now. It's crazy. It used to be like no points, just 990 feet, and now everything has 1% on it, just because you're trying to get that rate down a little bit. And then, quite honestly, everybody's doing loans for less right now because it's just like you're just trying to get people into the ability to make that payment, be at a payment spot that they kind of go, this makes some sense for.
Where do you see your activity? What price points is Loan Depot as a company? in our area here seeing the activity? Where's the most of the activity? Is it in the lower, 400 and under?
It's weird. Our average loan size is going down right now. So our average loan size is like 275, and it was running around 325.
Okay, so it's definitely that first-time home buyer kind of.
It really is.
Market.
Yep. And it's that and people that are moving up that have a lot of equity that they're putting down.
Okay.
Right. So that's where that opportunity for that conversation comes into play, that we are, we're just having that different conversation. But yeah, the loan amounts are a little bit lower, and we're seeing some of the, jumbo stuff just isn't really a thing, just because the conforming loan limit is so high that we don't see a lot of jumbo, and, but probably in that three, I'd say high twos to under five. Like that's probably the majority of our stuff. So I have one couple things. Our clock went away, but I think we're okay. Predict. Oh, we got to wrap up here in a little bit. So why don't you take us out? If you want to have a conversation and kind of look at your existing debt structure, or if you want to get pre-approved, just give me a call, 651-231-2500.
I just want to add to that in terms of problem solving is that when you're looking at a mortgage and you've got a lot of money, you're moving up, something like that, and you want to put another $100,000 down or $50,000 down because you think it's going to lower your payment.
It doesn't at all.
And then you're sitting there with $1,000 in car payments that you could eliminate.
Yep.
Buying the mortgage down at 7% is not as good as eliminating $1,000 car payment.
Absolutely.
So look at that, problem solve it. Give Kelvin a call, 651-231-2500. This is your Real Estate Chalk Talk, and we'll see you next week.
You've been